speed with trading. Meanwhile, the pre-opening rates are hitting the screen, and it's not all that muted actually. Nothing as bad as what the SGX Nifty indicated. I mean, SGX Nifty itself was just about 0.25% lower, but we're doing a little better than that at this point in time. It's largely a flat opening. So let's go over to the segment that was the vanguard yesterday, Nigel?
Absolutely. Well, metals were in focus yesterday. We saw ferrous and non-ferrous stocks do well. In fact, ferrous did a tad bit better. What should you do from here on? Well, to help us out with that, we have Aditya Welekar, Senior Research Analyst at Axis Securities, who joins us. Hi, Aditya. Thanks so much for joining in. Good morning to you. Well, yesterday we had a good run. Now, the street is divided. This is the actual thing, and this is the real deal. So to hang on to your positions. The flip side is, maybe in fact it's giving you a good bounce and the globe could still go into recession. So book out of your position. What's your sense on the steel stocks first up?
Thank you, Nigel. So good morning. Well, I think there are a couple of things. Number one is that the iron ore prices are rising in China. That is mostly due to the restocking ahead of the Lunar New Year holiday in China. So that is supporting the steel prices in China. And number two, the margins in Chinese steel mills, they are at a low level. So that is also supporting the steel prices. And of course, China reopening, that is building a positive sentiment overall. So based on these, if you see the Chinese HRC prices have rallied, and currently yesterday they were at $605 per ton from the low of 515 in November last week. So based on that, currently, if you see the Indian steel prices are at now discount to the Chinese imported prices. So the Indian steel prices definitely have well support at this level. Coming to, we stick to quality names like Tata Steel. So based on this run-up in iron ore prices, Tata Steel Indian operations are integrated with respect to iron ore. So also the valuations are attractive, and there is some upward room left for Tata Steel from this level. If you see, it's currently trading at a price to book of 1.06x, and at the peak of the cycle, it can go to 1.5x. So there is still some upside potential left for Tata Steel. Okay. And post,
what, Aditya, what about SAIL? They also have iron ore.
SAIL also has iron ore, but SAIL has certain legacy issues, especially their return on capex is so far not been very attractive, and their cost of operations are slightly sticky and sensitive to coking coal prices. So no one can predict what will happen to coking coal prices. Currently, they are stable and in the range of $280 to $290 per ton. But SAIL being more sensitive to cost and coking coal, we prefer Tata Steel over SAIL, and maybe we can see some upside in SAIL if the sentiments builds up and China's property sector really turns out and churns out good numbers. Then maybe SAIL can also rally, but maybe
you prefer
Tata Steel over SAIL.
Yeah. Got that. Okay, got that. In any case, SAIL is down almost 17% in the last 12 months. Tata Steel has seen a big outperformance. What about Hindalco? The valuations seem to be reasonable at about 1.1 times price to book forward. But the expectation is that Novelis margins are likely to worsen in the second half of the year. Would that be a concern for you?
Yeah, so for Hindalco, management has already stated that in H2 FY23, the Novelis margins will be impacted, and but from FY24 onwards, the margins should pull back to $525 per ton. That is their long-term sustainable EBITDA per ton guidance. In H2, they have primarily cited about the higher coal energy cost and logistic cost. These issues will get ironed out, and from FY24, we expect that Novelis will again pull back and will get back to its $525 per ton EBITDA guidance. And also its upstream aluminium business, the costs at upstream aluminium business are likely to peak out, the coal cost. So, and its copper segment is also expected to do well. So based on that, Hindalco is also has upside potential from even at this level. Once again at the peak of the cycle, it has
Yes.
gone to 1.5x price to book. For aluminium also, the tailwinds are US dollar is peaking out, and then China is opening. So aluminium is well placed. So currently at $2350. So can easily rise to $2,500 up to that level. So
Okay.
aluminum prices
Yeah.
have support of thermal coal.
All right. Aditya, at the peak of the cycle, some of these stocks, they traded 1.5 times, but at the bottom of the cycle, we have also seen them at around half or, 0.6 times price to book. But given that their balance sheets are in far better shape, maybe this time, even if things go wrong, maybe you'll find some better support and we don't go down to around half times price to book. Final question before we let you go. Aluminium, I think you mentioned are $2,500 per ton. So if you could give us, what is your estimate on aluminium prices as well as iron ore and coking coal for 2023?
So for 2023, we expect aluminium prices to trade in the range of 2,400 to 2,500. If the things work out, it may trade at a higher level of near 2,500. For iron ore, we have seen the rally for iron ore recently, so it may trade in the range of $115 to $120 per ton. And for coking coal, it's slightly difficult to predict because there are weather-related events from Australia. So that could drive the volatility in coking coal prices. But as of now, maybe $300 to $290 per ton guidance we can take.
All right, thanks a lot. Pleasure speaking with you. Have a great day. The pre-opening rates are settling a tad bit lower, nothing alarming. The Nifty is down about 30 odd points.